Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we will help you understand all the latest cues, especially the last half an hour of the trade today, the closing action in terms of the benchmark index moves, the sectoral indices and the stocks that are buzzing in trade right now. Well, looks like for the fifth consecutive session, the markets may be looking to end the session on a lower note, especially right now when you're looking at the markets, they're drifting lower towards the lowest point of the day. 177 points of a cut is what you can spot on the Sensex at 57,714. The Nifty also is trading at 17,016 with a cut of 26 odd points. Although the Sensex is trending lower than the Nifty today. Also, when you talk about the broader markets, you can actually spot it's the small cap indices that was actually doing better in the morning trade. In fact, bucking the index moves and over 1% of move was also being seen for that one. But even that index has drifted lower towards the lowest point of the day. You can see that on the charts as well. About 0.7% of an uptick is still remaining on that one too. Apart from this, in terms of the sectoral moves, most of the sectors that were actually trading higher in the first half of the trading session have actually drifted lower. Apart from say the metals and the pharma, rest all of the sectors have in fact moved into the red zone. So that's a complete change of situation that you actually saw in the morning opening trade, when apart from the FMCG index, rest all of the sectors were trading higher. Right now you can see sharp cuts being seen, especially on the realty pack. That's almost 1% down in trade. The PSU banks down by 0.8%. Overall, the Nifty bank has drifted lower. About 0.6% of a cut is what you can spot for that one. The FMCG index definitely down by 0.6 odd percent. Also, the IT stocks are trending lower at this point in time. The only solace in the markets right now is perhaps the metals pack, that's up by 2%, and slight gains being seen on the pharma index as well. That's 0.5% up in trade right now. Some of the Adani Group stocks are performing at this point. Adani Enterprises, for example, the top gainer on the Nifty pack, about 7% uptick for that one. Adani Ports as the second top gainer, that's also up by over 4%. Asian Paints has been hovering higher from the morning trade. Tata Steel and Titan, the other Tata Group stocks that are holding up in trade. But it's the FMCG stocks and some of the banking names that have drifted lower today, especially the big heavyweights like HDFC Bank, IndusInd Bank, also Bharti Airtel, that's trending down as well. But the focus of the discussion in today's trading session is going to be about understanding whether it is the right time for you to really look at equities as an investment, or should you be looking at some other asset classes as well. Remember, after retaining the best performing emerging market tag in 2022, the Indian equities have in fact turned out to be the worst performing market on a year-to-date basis, and a shift in the FII money to the other emerging markets that offer attractive valuations at the current levels, muted December quarter earnings, and also the global economic risks. These have been the major factors behind India's underperformance so far. Now, from the record highs as well, if you spot, the benchmark indices have actually corrected about 10%. And after just a meager 4% return that investors enjoyed on the index level in calendar year 2022, most of the market experts now expect 2023 as a calendar year to be another lackluster year for the stock markets, and the performance right there. So what should be your investment strategy now? Should you avoid deploying fresh money in equities, or should you look at other asset classes instead to park your money? That's what we'll find out. Joining in on the show with me is Mr. G Chokkalingam, the founder of Equinomics Research and Advisory. Welcome, Mr. Chokkalingam, and thank you so much for taking the time out for this discussion. First up, I want to kickstart by asking you and to understand your own outlook on equities as an asset class. There's a general consensus, like I said, that 2023 perhaps is expected to be a year of lower returns or no returns perhaps. Do you believe in that as well, as far as the stock markets are concerned?
Possible. Lower return from equity in 23 is possible because more than the global factors on the domestic front, we have the state elections, 5 state elections. Out of that, 2 are major state elections, and then that would be followed by general elections. So there would be little fear in the minds of people about the outcome of the general election before that from the state election. That is one point. And second, the corporate earnings shown some difficulties in the December quarter. While although the top line has grown, there has been a deceleration in the bottom line. That is mainly because of input inflation, and also the GDP growth has come down. So then fourthly, the exports of goods they started decelerating. So these are the areas of concern. However, one should not zero the exposure to equity because it's always for long-term investment. The right time is to buy cheap. But if somebody is expecting a significant return in the 6 months or 9 months in 23, that's a little difficult. So
Okay.
therefore, I would suggest diversifying between gold as well as fixed income securities like
Sure.
bank deposits.
Absolutely. I will come to that as well. I wanted to understand if the investors looking for investment opportunities, is it better to for them to really look outside of stock markets in 2023? Would you say that then clearly?
Definitely, I mean, at least 10% they can have exposure to gold. Of course, the gold also, behaving very odd. It's no longer, having inverse relationship with equity. So
Yeah.
it also started falling along with equity. So but still it is better to have because very interesting insight is that in the last 10, 20 years, even if gold prices globally do not go up, the domestic price of gold keeps going up, the landed price. That is because of the consistent depreciation of rupee. So there is a possibility of rupee further depreciating, and therefore the gold can exposure in the domestic market to the gold can help the investors. So hence I would suggest 5-10% exposure to gold and also around 20-30% exposure to fixed income securities in the overall wealth, not within the equity but overall financial wealth. So 20 to 30% they can have exposure to fixed income securities. Within that, definitely fixed deposits, but without worrying about the rate of interest. Safety of
Yeah.
deposits be important more than the rate of interest on the deposits.
Exactly. You pointed out correctly that both gold and fixed deposits have perhaps outperformed the equities in the past 12 to 14 months odd. So let us talk about them one by one to get a better understanding to all our viewers right there. First on gold, like you also pointed out that perhaps it is better for investors to allocate about 5 to 10% of their investment portfolio to gold at this point in time. I wanted to understand, should they increase the weightage in case they already have about 5%? Should they look at increasing it to 10%? Those having an exposure to about 10% in gold, should they also look at increasing that in the current realm?
Certainly, one can even go, conservative investors can go even up to 15% because, the Ukraine war, there is no end to it.
Yeah.
And also, we are not sure what would happen in Taiwan, although I am optimistic.
Yeah.
There is a little fear on the disturbance in Taiwan. And thirdly, the oil and metal prices are down. The steep rate hike might lead to deflationary conditions, more so with the recent fall of the banks. And that's what happened post Lehman crisis also. The interest rate almost came down to zero, which is a sign of deflationary condition. So in
Yeah.
those possible conditions, yes, conservative investors can go up to even 15% exposure to gold. As I mentioned, even if gold global prices fail to reward the Indian investors,
Right.
the possible rupee depreciation can help them to make some decent return. So therefore, one can go up to 15% of total disposable wealth, financial wealth.
Sure. What about fixed deposits then? We do know that we are in a rising interest rate scenario. Some of the banks, in fact, the small finance banks, are offering as high as 9% interest. And most of the investors who've been looking at equities as a higher return investment opportunity are now looking to compare this. On the one hand, you have fixed deposits where you don't have to have that much risk related to markets, and you still get about 9% of fixed and assured returns right there. On the other, those investors who've been looking at a high return opportunity are looking at historic 4% as the just past year as well. So you, on the one hand, you increase your risk as well, and then look at investment opportunity in markets. So would it not be the right time for them to increase their allocation to the fixed income opportunities like fixed deposits as well?
Certainly, I mean, I am always conservative in suggesting to the retail investors. I never tell them to put 100% of their possible financial wealth into equities.
Yeah.
Never in the lifetime. One should always have worst case scenario also 30% of the financial wealth in fixed income securities like a bank deposits.
Yeah.
So now one can even consider 40-45% of the total wealth, financial wealth, excluding the dwelling unit in which they live, they intend to give to their kins. So except that, you consider the total financial wealth as a base, anywhere even 30-40% one can invest because A lot of uncertainties are there apart from domestic election, some few economic parameters, and then more monsoon forecast is yet to come, then global political situation. So definitely one conservative investors can go even up to 40%. Now, where to invest, again and again, I would caution that, when you are considering fixed income security, never keep the rate of interest as a main criterion for investing in the fixed income securities.
Okay.
So always go for a very highly rated, finance companies like Bajaj Finance or, Sundaram Finance. So never compromise on the quality of the finance companies just for the sake of interest. You should be clear whether, your concern is the safety of money, capital, or return on capital. So in fixed income investments, one should worry about return of the capital rather than return on capital and then risking your money and losing it. So
Right.
always better to diversify between solid banks and the well-established finance companies over the decades, like Sundaram Finance.
Hmm. Okay. But would you be able to give more clarity to investors who are still comparing the rates of interest? I know you have just talked to us about that, it's not the right parameter to really go in for the fixed income. But just to compare for all the viewers who are still looking at both whether they should park their extra cash, idle cash right now to fixed deposits or to equities, will equities not be able to beat the 9% interest rate or the 8.5% interest rate that we are looking to get in the fixed deposits right now?
Yes, next 9 months you may not be able to get 9% return from the equity, quite possible. Unless oil prices crashes further to 60, $70, then the situation would be different for India, because always a global gain is the gain for India. If that situation doesn't happen, then you may not get 9% in the remaining 9 months period. And then it is better to lock in fixed income security now, because I am of the firm view, because of the fall of banks in the US, we are close to the peak of the rate cycle, not only in
Sure.
US, even in India. So therefore, maximum another only 25, 50 basis hike can happen. And
Sure.
after that, you will see the reverse cycle. So therefore, one can rush to banks and, the lock-in more than 1 year deposit at possible highest interest rate right now.
Sure, sure. So, at best, what is the best case scenario that, and what is the kind of rate, rate of return that you expect from equities in this year, 2023, at best?
See, the Sensex has gone up to 63,000. Now it is below 58,000. Now, my sense is that the best case scenario, the Sensex can go back to around 62,000. That's what happened many times repeatedly, and which would mean another 7-8% return is very much possible by December,
Okay.
provided there is no more major the fall of financial institution or banks in the US, or there is no failure of monsoon, and
Sure,
also the state elections do not give any uncertainty in the minds of the investors.
sure.
So in that case, yes, 7 to 8% by end of December is very much possible. Sensex once again can go back to above 60, around 62,000 level.
Okay, but what, for the first time since August of 2022 as well, the mutual fund industry has also seen inflows through the most popular systematic investment plans or SIPs also drop on a month-on-month basis in February. This is the data that we have recently just got today. And remember that SIP flows had touched new record highs consistently for the last 6 consecutive months. They reached up to 13,056 crores in January. The figure still remains above 13,000 crores, but there is definitely a dip or a drop marginally on a month-on-month basis as well. So I wanted to understand from you, what are the key factors that are driving SIP flows to slow down?
Yeah, certainly. There are two things which are happening. One is a major structural change. Last 4.5 years, the investor base of investors in the capital market more than doubled. BSE took 145 years to get a 4.5 crore investor base, but in the last 4.5 years, now it is coming close to 12 crore investor base. It's very surprising to note that every week, around 4 to 5 lakh new investors are getting registered on the BSE platform. So on the one hand, you are seeing the robust inflow of investors. On the other hand, what has happened, if you look at BSE small cap segment, particularly the Group B segment
Yeah.
within BSE, which are basically small caps, the market cap, from the peak level of some 17, 18 lakh crore, now it has fallen to around 7 lakh crore. So almost, 45% fall has been there in the combined market cap of the group B, which is basically small cap segment within the BSE. So what it means, a lot of investors starting from September 2011, because 2000 since 2011 September, we are seeing fall in the market.
Yeah.
And particularly in the last 6 months, we have been seeing a lot of fall in the small caps. So a lot of retail investors who predominantly invest in the small cap space, they have lost a lot of wealth in the small caps. And on an average, any small cap, if you take, it is down by minimum 30% from its peak market cap. So therefore, though there is a lot of interest among the retail investors to participate in the stock market for the long-term wealth creation story,
Sure.
the
Sure.
liquidity appetite is going down, because what is already invested has seen minimum 25 to 30% fall in two-thirds of the small cap stocks. So that is the reason behind this moderation in the inflow of SIP money.
Right. Mr. Chokkalingam, okay, let's take an example to help a wider viewing audience as well of ours as to how should they create their investment portfolio if they are deploying a fresh money. Say, for example, a person has 10 lakh rupees to invest in this current year of 2023. What is the division that they do between equity, gold, fixed income instruments to get the maximum mileage and the maximum returns in this year?
So first of all, I would advise retail investors that you proper evaluation you do. If you can wait on the basis of research, you do that and then start investing. But while investing in the equity, try to minimize the risk and don't expect the return. The return should be the byproduct of your thoroughly research or stock selected on the basis of key parameters. So the major problem is that a lot of people want to make money intraday or intra-week or intra-month. So the moment you compromise on the core objective of equity investment, the chances of losing money heavily. There are many, stocks which claim to be in IT, e-commerce businesses, but basically turned out to be trading companies and destroyed 90% of the wealth. So therefore, this is most important, that you vet out on the basis of thorough research, or take help of advisors and research people. Second, never put 100% of the money in the small caps. After 2018, there has been a change in the structure of the equity investments after AMFI changed the criteria for investing. So what I would suggest, that invest minimum 30% or even 50% in the top 250 stocks in terms of market cap. So the top 250 should include even the Nifty Sensex stocks. So 30 to 50% of your portfolio should be in those top 250 stocks, because they don't guarantee the return, but they guarantee the easy exit. Otherwise, in small cap, you will see only every day down circuit, and in 3-4 days, you will lose 50% of your wealth. Normally, that doesn't happen in the top 250 because of the institutional holding. Third, don't put 100% equity. Always keep 30% minimum. If you are very conservative, 50% in the fixed income securities and gold. So never put 100% of your financial wealth in the equity. So right now, I would suggest that you start with, if you are a fresh investor, 50% allocation to equity, another 10-15% gold, 35% in the fixed income securities, very safe bank deposits or safe finance companies deposits, which have the track record for more than decades. And start from there. So within 50% of the equity, as I said earlier, anywhere 30 or 50% of that 50% you allocate to top 250 stocks, so that a lot of uncertainties are there. If there is a need, you can easily exit. So remaining 30%, you put it in a small and mid cap wealth creation story, and there again you develop the select the stocks on the basis of quality of the management, the quality of balance sheet, particularly the leveraging, the working capital crisis, and then the valuation on comfort on the valuation, and the business model, the scope for business model, the business to grow, and also avoid in small cap the management which keep changing the name of the company based on the the thematic bull run in the market, and the stock prices have moved. Like for example, Quality Dairy, if you take in the last 20 years, it comes to 10 rupees, it goes to even 1,000 rupees, again comes to 10 rupees. So such a huge volatility in the stock prices. Then the management every third, fourth year, depending upon the boom in the market, keep changing the name of the company. All those companies you avoid. Go for time-tested management, and then adopt these criteria, balance sheet, valuation, comfort, business model, then I am sure this is the best place to create wealth. Let us not forget the fact that in 92, the market cap was hardly 2-3 lakh crore. Today,
Sure.
even crash, it is around 267 lakh crore. And in the long term, there is no match for equity asset class to make wealth.
Okay, so in the long term, definitely equities as an asset class can supersede all the other asset classes. It's a great place to create wealth, but in 2023, perhaps your money would be safer if you diversify your investment portfolio and allocate more wealth and more weightage to fixed income products and also gold. That could add more sheen and protect your capital in 2023. Well, thank you so much, Mr. Chokkalingam, for being with us and sharing with us all these insights with all our viewers. Well, fifth consecutive day in a row, and the markets are trending down. We have already seen about 10 lakh crore rupees, getting erased from the investors' basket. Until yesterday, the 4 days of consecutive wealth loss that we've seen. There's going to be more erosion today as well. 0.5% gone for this Nifty right now. It slipped below the 17,000 mark, 16,953. That's the level that you're watching the Nifty at. Almost 0.7% of a cut for the Sensex as well. 57,506, the current level of the Sensex right now. It's a broad-based sell-off that you're witnessing. The markets have changed the picture from the first half of trading session to as we're closing the day. We're looking at most of the sectors slipping into the red, barring the metals and pharma. Rest all of the sectors are down in the red. Of course, a lot of changes in the market breadth as well. Now you're seeing 30 stocks declining versus 20 advances. So the market breadth, which was positive in the first half of trading session, has also changed. A lot of losses being dragged by the Nifty Bank as well. That's now down by over 1%. So that's where the pull is coming from. You can see the PSU banks down by 1.2%, private banks down by 1%, and financial services also down by 1%. So the banks are taking a beating, and along with it, you're seeing the other rate sensitives, the autos, the royalty pack also dragging in trade in today's trading action. We'll keep you posted with everything that's buzzing on the D Street, so do stay tuned with us onto Business Today TV to catch all the updates from the world of business. Don't forget to subscribe to this channel. You can also continue to engage with us on our social media platforms as well. Until then, many thanks for tuning in.